for it to make any sense.
All right. Speaking of the stock market, Sacks, you've got the background of the New York Stock Exchange as your Zoom background today. What's that about?
Yeah, so Bird listed on the New York Stock Exchange today. This is a company that I've been involved in pretty much since the beginning. We led the Series A round back in 2017. It was actually the first check I wrote as a VC to lead a round at Kraft. And 4 years later, public company on the New York Stock Exchange. Pretty amazing.
And so you're literally at the New York Stock Exchange as we speak. So it's a first remote bestie.
Yes. And you can see behind me, that is the floor of the New York Stock Exchange. It's not like, if you've seen the movie Trading Places, it's not like that anymore. There are no stockbrokers. There's no like paper flying around.
Got it.
I'm not really sure what the purpose of all those monitors are down there. It feels to me a little bit like a movie set.
It is like a movie set, yes.
Yeah. And so people like us come here to record things. But as we all know, all the trades are really happening inside giant machines.
Can you turn around and just start yelling, booyah? Just yell booyah. And let's see if security comes and
no, I'm elevated above the floor. No one can really hear me here. I'm in like this sort of broadcast booth.
So take us behind the decision to go public as a 4-year-old company. We were expecting, Airbnb, Ubers, and Lyfts took over 10 years to go public. Now here we are sitting on a 4-year-old public company. Is that a good thing, a bad thing? Something in between, and how does the board and the management team make that decision to go public?
I think it's a good thing because the company wanted to. I think it had the opportunity to. It grew very, very quickly before COVID. Then you had COVID was like sort of a huge setback. Basically the scooter industry just stopped for at least 6 months because of lockdowns. But then coming out of COVID, they bounced back really strongly. They kind of pivoted their model to what's called a fleet manager model, where basically they're putting a business in a box for a local operator or local entrepreneur to buy the scooters with financing and manage the fleet themselves. So it's a much more highly virtualized model. And so as a result of that, in Q2, they just did $60 million in revenue in the last quarter. And I think it was the gross profit of something like 27%. And it had a loss of like 12 million. So they're very, very close to getting to profitability. And, the company's only 4 years old. It took Uber 12 years or whatever to get to be public. So it's been a pretty amazing ride. There've been a lot of big ups and downs, but, so it's kind of a pretty sweet event.
What is it trading under now? I know it was Switchback was like the SPAC name.
Right. So today was the first day it started trading under the ticker symbol BRDS. I guess all birds took BIRD, so we took BRDS. And, there's a total number of shares outstanding of, I want to say roughly 300 million. So it's about a $2.4 billion market cap, as it stands right now, which, for a Series A investor is pretty great.
Really happy for you, Sacks.
Yeah. Congratulations. It's great.
Congrats, dude.
We heard last week Sequoia is going to do the Sequoia Fund, this evergreen fund, keep owning shares. Now, as a VC, do you distribute after 4 years of this investment and you made multiple investments, or do you make the decision, hey, we think it's undervalued, we have, conviction in the company, we were going to be in it for 10 years, or do you just take the quick win and give everybody their shares?
Well, I've agreed to be on the board for the next year. So, I'm planning to do that. And we have a traditional 6-month lockup. And so at that point, we'd have to make a decision about when or how much to distribute the shares. And this is the first time we've been confronted with the decision. I mean, Kraft Ventures is only a 4-year-old firm. And like I said, this was actually the first round that I led as a VC. So it's the first time we've been confronted with a distribution of this magnitude. We've had some smaller distributions. So yeah, we still have to make those decisions. We haven't decided yet what we're going to do.
If the stock is up, let's say, meaningfully in the next 6 months, and you get to that, 6 months and a day, and you have the ability to distribute, and it's up 25%, and you're looking at it, business is thriving, you're on the board, do you consider holding for a year or two so that you can distribute at $16, $25, or whatever your price target is?
Maybe. We haven't gotten to that point yet. So yeah, I guess what I would say is that our bias would be to distribute shares to our LPs so that they can make their own decisions about whether to hold it or not. As long as we think the stock is, priced fairly. If for some reason we thought it wasn't, then there'd be an additional reason to hold on to it and make the distribution later.
Chamath, what are your thoughts on this, given it's come up before, and a number of us are going to be faced with this decision, and then we see Sequoia has got LP buy-in for an evergreen fund?
Well, I think an evergreen fund is different from having to figure out how to do distributions. So they're solving for two different ideas. The evergreen fund is really good because you don't have to do this continual fundraising process, and you can basically roll gains back into the next tranche of invested companies in an easier way. I like that idea. It was pretty rare at the time. I remember when I was starting Social Capital, the only fund that did it really well was Sutter Hill. And for a whole host of reasons, I decided to not do an evergreen fund. In hindsight, I think for me, that turned out to be better because then it was easier for me to wind down and have a clear demarcation of when it was just myself and other LPs versus when it was just my capital. But there were some really good reasons to do it. The hardest thing I think that Sequoia is going to find in this new iteration is at some point, somebody's reputation will be on the line for judging public equities. And it's still not clear to me that people who live and breathe venture can context switch well enough to then live and breathe public equities. So just the best example I would say is like Tiger Global. When you look inside that organization, which is incredibly well run, there are two superb investors that carve the universe up, right? You have Chase Coleman that runs the public book, and you have Scott Schleifer that runs the private book. What does it prove? To me, it proves that it's just very hard to find a person that can do both. And the context switching is very complicated. So maybe Sequoia finds an incredible public market strategist that can then manage these positions. Otherwise,
but Chamath, they've done this for a few years, right? They've Sequoia. I don't know if people realize this. They set up the Heritage Fund, and they set it up with only GPs' money. It's got billions under management, and it's been making late stage private, but mostly public equity investing.
I know, but that's a fund of funds. What I'm saying is, I'll be very honest with you. If I was an LP of Sequoia, I would want the money back. And the reason is I'm not sure that Sequoia can compound money in the public markets anywhere near what I could. So
do you buy the point that they make that like exiting some of these left most of the, kind of value creation on the table?
No, I think what they're saying something much more subtle, which is they exited and they have regrets for selling. You have to remember when Sequoia distributed Google, every single partner got Google shares. Now, had they held those shares, they wouldn't be saying any of this. And famously, I'll tell you,
they held their shares.
I
actually do.
Fair enough, but maybe they did, maybe they didn't. But let's just put it out there that, for example, I know explicitly when I almost merged Social Capital with Kleiner Perkins like 6 years ago, I spent so much time with John Doerr. The most incredible thing that I was so impressed with Doerr was he told me he had never sold a single share of Amazon that was distributed to him. And he had only sold a handful of shares of Google only to fund future capital requirements at Kleiner at the time. So I just think that ultimately, I think probably what Sequoia was saying is, man, I wish I had not sold my Google shares when they were distributed to me, because otherwise they wouldn't make that claim.
No, I think what they're saying is more subtle. I think they're saying you as our LPs should have held them. We are on the board of these companies from day one. We have better insights in the second decade than in the first. Production Board founder David Friedberg, how do you think about early exits, distributing capital? Because you do have also with a startup studio structure, which you should explain to the audience how a startup studio works, because you create companies, which is, was a terrible place to be maybe 5 or 10 years ago, but it turns out you're in the best place because 0 to 1 is where all the value is created. Explain the two things. What a startup studio is for people who don't know, and then what's your view of selling early if a company of yours goes public?
I think there's a bigger kind of framing here, which is a lot of investors, professional money managers have tried to find ways to create what is called permanent capital, which is a vehicle whereby they can continuously make investments, decide when to sell those investments, and recycle the capital into new investments, with the idea being that over time, they're not at risk of capital outflows, meaning investors pull their money out, and they're not at risk of, needing to kind of go out and raise more money, and they can share in the value creation as they grow their book value over time. years ago, a bunch of hedge funds set up public reinsurance companies. Dan Loeb did this. What's his name? Einhorn did this.
Bill Ackman did it.
And basically, Bill Ackman did it. What they did is they set up a public company, a new public company, a reinsurer. And then they used that reinsurer to underwrite reinsurance. And when you underwrite reinsurance, you get all this capital that you can then go invest. And then the hedge fund managed that investment. And because it's actually a public company, it's got a balance sheet, the shareholders can't pull their money out, right? It's just got a balance sheet. And the hedge fund was managing that balance sheet and, generating good returns. And this is effectively what Warren Buffett does. And everyone looks to Berkshire Hathaway and Warren Buffett as kind of the key kind of long term here. Which is, hey, look, if you can keep investing and keep compounding value, this thing can grow, exponentially over time. So, the way we set up the production board, I had the option of raising a fund and being a fund manager. I chose to set up the production board because I was much more interested in, I think, the similar sort of vein of what Sequoia is saying, which is like, how do you become a longer term builder and a longer term holder, and where you don't have these incentives to return capital because you only get paid if and when you return capital. And, and then you're kind of making these decisions to, because your shareholders are saying, well, you had a good return, quickly give me the shares back and and mark your profit and take your share. And I was also more interested in, look, the fact is over time, there's always going to be opportunities to chase with the capital. So if we have a great gain, if something works out really well, we can take the gain and we can reinvest that capital in building new things. There's no shortage of opportunities to pursue for the rest of my life. So that's why I set up the production board initially in partnership with Alphabet. And then later on, we brought in, Bill Gates and other Allen and Co. and other kind of investors that have a similar sort of mindset, which is like, let's just, if we have an exit, recycle that capital and continuously
because
kind of build value. Because
they're not looking for a quick win.
They don't have pension payments to make, right? They don't have a reason to distribute cash. And so same with me, like I don't have a reason to take cash out. So the objective was just build this thing over time and grow value over time. And that's why I set it up the way I did. And I think it allows us to make, really long-term bets that are super risky. Most of what we're doing is super technical and difficult and maybe very hard to pull off. Many of which are still, after many years, in a very early stage.
So you need very patient capital.
And also the preference for not trying to find exits. But I have found this. I'll tell you one thing. I have been through a number of circumstances where I have seen businesses I've been an investor in or involved in that have traded long-term value for short-term opportunity, meaning there's an opportunity to make a business that you can then go raise capital against. You change your strategy to do that, then you go raise VC funding, and now the business looks like it's working. But the 10x or 100x opportunity was taken off the table because you ended up going down this different path that was a sure thing, that was more likely to work, that created value in the short term that allowed you to mark up your investment or raise capital against that, but you gave up the big long-term thing. And I think that's something I've been trying to avoid with the structure. And it certainly makes sense with some of these other folks and what they're trying to do.